you ever talked to an investor from another state and wondered why in the world would they buy in a market where it has a much lower cap rate and lower cash flows when you could purchase in your market where there's higher cash flows? Well, there's three key principles that you should understand when evaluating whether it's better to buy in a lower cap rate market or a higher one. And we're going to talk about what those are and how you should evaluate today. So the first one is you need to really understand the market principles. So the reason that people are buying in lower cap rate markets and why they are lower cap rate to begin with is the fact that they have very strong fundamentals. So New York City will always be New York City. It'll be a hub of business and the overall world economy ongoing. Okay, that's not going away, and the sureness of that understanding, the solid principles of that vast economy is why it's a lower cap rate market and why people continue to buy in that market because of the fundamentals of that market. So if it has a lot of opportunities coming in, employment is steadily growing, population is growing, those are all key factors to understand and evaluating the strength of the market. So that's principle number one. The second one is comparing the returns, and that's the cash flow plus the appreciation of that property over a certain period of time. So let's say you looked at two properties over a period of 10 years. You purchased them both for $1 million, but the property in the higher cap rate market is going to have higher cash flows than the property in the lower cap rate market. But the property in the lower cap rate market will have higher appreciation because it's a lower cap rate than the one in the higher cap rate market. So you need to understand both the cash flows as well as the appreciation over a certain period of time so you can look back historically what those have been. And then you bring in the third factor evaluation, which would be knowing the time value of money. So what I mean by this is, let's say that you look at the two properties in question. The property that brought in a higher cash flow, think about all those years. So if you held it for 10 years, that you're earning cash flow every year, more cash flow than the higher appreciation market. So even though the dollars might be exactly the same at the end of 10 years for both properties, the one that paid cash flow sooner is giving you more value because you can then take that market and let's say you go put it in the stock market and earn an 8% return on that investment. That's increasing the return more than the property over here that only returned the higher amount of appreciation in year 10. So in order to properly compare those two markets, you need the cash flow, the appreciation, and the value of those cash flows over that time period. So there's a calculation you can do called the net present value calculation, which incorporates those three things, the cash flow, the appreciation, and the time value of money, into the calculation so that you could compare the two properties side by side and say, okay, this property, based on the higher cash flows, over time actually performed better than maybe the lower cap rate property, which had a higher appreciation but didn't have the cash flows. Or maybe the lower cap rate actually did provide a better return just because the appreciation was so much greater that it outweighed the cash flows over time. So you won't know unless you do that calculation based on the two different properties in those two different markets to compare. But truthfully, it's all talk, it's all just speculation until you actually do the math. And what I love about that is when you do the math, you have the answers, right? But nothing is ever perfect in today's market. And one of the reasons why we as real estate investors love real estate is the fact that you can add value and you know your market, and that knowledge helps to bring in a better return to your real estate investments. So it's still always the best principle to know your location, but it's your knowledge that makes the difference. So you could become super knowledgeable about a market that's on the other side of the country if you wanted, but it's just knowing your market. So I hope those three factors of understanding how a cap rate in a low market or a high cap rate market really compares. I hope that brought you some value. If you're looking to invest within the Northeast, please contact us. We're always happy to help our multifamily investors. Feel free to comment below what your strategy is for investing in different cap rate markets and or maybe out of state markets and how you've done that as well. So we look forward to hearing from you soon.